Determining the exact amount of debt a project can support is one of the most technical yet critical steps in structuring a financing. This is where debt sizing comes into play, and understanding how the financing amount is defined helps sponsors and lenders align expectations early in the process. The core principle across most transactions is that the financing amount is set as the lowest of several calculated thresholds. Two tests typically apply. The first is a cash flow-based test, using the debt service coverage ratio, often abbreviated as the coverage ratio, which measures whether projected cash flows are sufficient to cover scheduled debt payments with an adequate margin, commonly calculated on a semi-annual basis, over the loan's life using conservative long-term revenue assumptions. The second is a gearing test, based on a maximum debt-to-equity ratio, ensuring the sponsor maintains sufficient equity exposure in the project. The actual commitment amount is generally confirmed at financial close, once the base case financial model is finalized and all debt sizing criteria are satisfied. Importantly, this sizing usually assumes that contingent facilities, such as standby loans, standby equity, or letter of credit facilities, will not be drawn, while all associated fees and interest are still factored into the base case to ensure a conservative outcome. For structures involving multiple debt layers, each tranche may have its own sizing logic. A junior or mezzanine facility, for instance, is often sized using a higher minimum coverage ratio and a maximum loan-to-value ratio at maturity, reflecting its subordinated position in the capital structure. Beyond the initial commitment amount, it's equally important to track available funding throughout the life of the project, particularly during construction. This includes undrawn loan commitments, expected pre-completion revenues, funds held in project accounts, and any remaining equity commitments. This broader concept, sometimes called available resources, ensures the project has enough liquidity to reach completion, even if drawdowns are delayed or costs shift. Finally, maturity dates are typically linked to financial close or the final scheduled repayment date, with any incremental facilities structured to mature no earlier than the existing senior debt. Together, these mechanisms ensure the financing amount is not an arbitrary figure, but a carefully calculated number reflecting the project's real cash generation capacity and risk profile. If you found this summary useful, don't forget to like, subscribe, share this video with your colleagues and friends, and check the description below the video for useful information. Thanks for watching, and see you in the next episode.